A covered call is an option strategy that can help investors earn additional income on securities like stocks or ETFs that they already own. Many investors regularly sell covered calls to generate income because they have a higher probability of success than other option strategies. A covered call involves selling a call option above the stock's current price to collect a premium. If the stock's price rises above the sold option price and the option is exercised, you are obligated to sell the stock at the strike price. As long as the value of your stock doesn't decline more than the value of the premium received, you make money, not accounting for commissions or fees. For example, suppose there's an investor who owns 100 shares of stock from a company. This stock is currently selling at $100 per share. After analyzing the stock's price movement and trend, the investor doesn't think the stock price will rise much in the next few months. So he decides to sell a call option on his stock with a strike price of $105. For selling this option, he earns $300. Now, depending on what the stock does, one of two things will happen. As long as the shares don't rise above $105, the option will expire and the investor keeps his stock. However, if the price goes down, he could lose money on his stock, but any losses could be partially offset by the option premium, less any commissions and fees. But if the stock does move higher than $105, the option would likely be exercised and the investor would be forced to sell his shares. However, he still made a $5 profit per share in addition to the option premium, less commissions and fees. But keep in mind, there's a risk of missing out on further gains if the stock goes up even further. There is also the risk of the stock's price going down, but that can happen any time you own a stock. A covered call doesn't just bring in income on stock you own. Some investors buy stock and sell a covered call at the same time. This is called a buy right, and it can help lower the cost of purchasing the new stock. Let's look at an example. An investor is interested in a company that is selling its shares for $100. The investor decides to buy 100 shares for $10,000, but doesn't want to pay the entire amount. If she writes a covered call at the same time, she'll earn a $500 premium, reducing the cost to $9,500. If she wrote that same $500 covered call every month for 20 months, and the stock stays below the strike price of the covered call, the premiums she'd earn over time, less fees and commissions, would help pay for the stock. A covered call is just one way to expand your investment strategies. If you're interested in learning about other option strategies, we're here to help. Take control of your financial future today.